Hi there, welcome to kneppyinvests. Time for another financial year 22 results video. This time I'm going to focus on a company I've done very little research in the past. So it was exciting looking at this company in a little bit more depth, not total depth, because my question around this company right now is what is the intrinsic value? And this is a very important point because when you look at the valuation of this company, around about or just above $4 billion, the company is profitable, but I think it just became profitable. Operating cash flow positive, but free cash flow negative. We'll talk about that later in the video. So when you look at the valuation metrics, this company looks really expensive. So I think it is a bit of a trap just to focus on the valuation metrics because NEXTDC is a data center company and they are building data centers. They've already got maybe 6 to 8 data centers right now. And these are relatively small data centers compared to what they are building. And because they are building a lot of data centers and pretty big ones, the one in Sydney looks huge, which should be in operations in about 3 years' time, they have to spend a lot of money. So this is a capital intensive company that burns through cash to build up these data centers, but eventually this company will be raking in lots and lots of cash. And that's what the market is expecting for this company in the future, because if you value this company based off the current cash flow, the current profit, you would say this company is the most overvalued company in history. So the main question I have about NEXTDC is what is the intrinsic value? I'm not going to answer that question in this particular video because I think you'd have to go really in depth into this company and really value each single data center and the possible cash flows in each single data center, not only the ones they have in operations now, but also the ones they are building. I'm really enjoying doing these financial year 22 results video, and I am planning ahead. And I have 5 further videos at least I am going to do, and those 5 videos are SEEK, Index, Valuation, Financial Services, GUD Holdings, and High Tech. I'm really looking forward to looking at Index, GUD Holdings, and High Tech because I have never had a look at these 3 companies in the past. And one of the reasons I really like doing these videos is because I'm exploring, and even though I am discovering new companies, that discovery of these new companies, and when I say new companies, I know the names of these companies, but I have never had a close look. I'm not really finding any companies I want to invest in, but it just opens up the door that maybe one of the companies that I would never have thought about investing in might be a really good investment. And the other 2 companies I know a little bit more about, SEEK and Valuation Financial Services. I am not a shareholder of SEEK. I have been in the past. And if the value becomes really good for that company, because it is a high quality company, I will take a position in SEEK. And Valuation Financial Services, I hope to be a very long-term holder of that company. I have no reason to even think about selling out of that company, even though the share price has pulled back a little bit because of the overall weakness in the market. So if you do have any suggestions on companies you'd like me to cover in the financial year 22 series, I would prefer these companies to be profitable and at least operating cash flow positive, because those are the companies I am focusing on right now because I'm looking for long-term holds, and long-term holds are high quality companies that are profitable and that are at least operating cash flow positive. So leave your suggestions in the comment section of this video. Whenever I first start researching a company, particularly if it's a company I don't know much about, the first thing I really want to determine is whether a company is high quality or low quality. It can be hard. So the things I tend to focus on initially are revenue growth, and I also look at the long-term chart. And if I see revenue growing consistently over the past 10 years, and if I see the share price significantly higher now than it was 10 years ago, and there's no significant, say, cyclicality to it, I might consider the company to be high quality. And that is true for NEXTDC. Now, just because I might consider a company to be high quality when I first started researching the company doesn't mean it will remain there. I could change my mind as I develop my research on a company. So it's going to be interesting to see if I will change my opinion on NEXTDC as I further my research on this company. And maybe this is a low quality company, but at this point in time, I do consider NEXTDC to be a high quality company. And I also should mention the reason why I want to determine whether a company is high quality or low quality is the way I treat high quality companies is a little bit different than the way I treat low quality companies. And because I consider NEXTDC to be a high quality company, the value or the current value of the company is really important. But it does become tricky for NEXTDC because if you look at the valuation metrics right now, you'd say this is the most overvalued company on the ASX. So you do have to dig a little bit deeper into NEXTDC. In fact, might even do a discounted cash flow for this company. I very rarely do those. I haven't done it yet because you can't really look the current valuation metrics to determine whether this company is good value at current share prices because they are a capital intensive business. They are spending a lot of money building up data centers. And as more data centers come online, their revenue will grow, their profitability will grow. And there's going to be some point in its future, I'm not sure when that's going to be, where this company is simply going to be raking in the cash because of these data centers. So that could be 3 or 5 years down the line. And I think that's what the market is seeing. That's what those research analysis of this company have seen, that eventually this company will be generating a mountain of cash flow because of these data centers they have already and they are developing. There are two ways I determine whether, initially determine whether a company might be high quality or low quality, and that is looking at the revenue growth. We'll look at that later in the video. And another way I can determine whether a company is high quality, low quality is just by looking at the long-term chart. So this is the weekly chart for NEXTDC, a 10-year weekly chart. And the share price has gone up over the past 10 years. And to be honest with you, it has been consistently going up, particularly from about 2015 to about 2021. However, there is a little bit of weakness in the share price over the past few months. And it does look like, just based off the weekly chart, NEXTDC's share price could be moving into a downtrend, and we have not seen that for about 7 years in the NEXTDC chart. So over the last 7 years, this company has been in an uptrend, and does look like there is a double top at $14. We saw the share price reach it twice in the past 2 years, and the share price over the past, say, 4 weeks has moved lower than a nice support level, well, resistance level now, because it has broken that support level. So the share price of NEXTDC is in a downtrend, and as the share price goes lower and lower, perhaps this company is becoming more attractive. And that's why knowing what potentially the intrinsic value of this company is really important at this point in time, because then you can compare the share price or the valuation of the company to the intrinsic value, maybe have a little bit of a margin of safety there, maybe 20-30% margin of safety. And if the share price gets low enough, potentially this is a low risk buy. But at this point in time, I have no idea where that is. But as the share price does go lower, and as I do more research on this company, it does become more attractive to me. So I might actually delve a little bit deeper into this company, maybe through those discounted cash flows, try to find a possible intrinsic value for this company. But that's going to be probably over the next few months, because I think the share price of this company could fall further from here. Now to the financial year 22 results for the company. And before we get into the revenue, profit, and operating cash flow, let's have a look at the current valuation of this company. Now, at a share price of $9.11, and I think the share price has decreased a little bit from $9.11, the market cap of this company is $4.2 billion. So let's have a look at some of these financial metrics. Now, straight away, revenue is only $291 million. So not a lot of revenue at this point in time, but revenue is growing and it will continue to grow. And I can just imagine when the Sydney data center, I think it's S4, comes online, and if they get 100%, I forget what they call it, but if it's full, 100% full, then that's going to be generating a massive amount of money. And we'll have a look at why that might be generating a massive amount of money later in this video. Now, only $9.1 million of profit in financial year 22. So straight away, when you compare the profit to the market, you might be saying, yeah, this company is completely overvalued. But there's a reason why the profit is low. We'll talk about that during the rest of the video. The operating cash flow, which is minus the leases, something I do with operating cash flow, is only $116 million. So significantly higher than the profit. The reason it's significantly higher than profit is because this is a capital intensive business. they do have a lot of money set aside for depreciation, amortization. I'll talk about that again in the video. And again, because it's a capital intensive business, they have to go into debt or maybe do capital raisings to build these data centers. So at this point in time, they have $1.1 billion of debt, which is growing. Seems like it's growing every single year. But they do have a lot of property, plant, and equipment because they have these data centers. They own these data centers. And so the current stage, property, plant, and equipment is about $2.6 billion. So a lot of equity, a lot of assets on board, but they also have a lot of liabilities, including a fair bit of debt. And the earnings per share is only 1.99 cents. So look at that, compare that earnings per share to the share price. And again, the valuation metric or PE ratio is really high for this company. So you really have to ignore that. And don't just focus on, PE ratio or the price operating cash flow, because then you're going to be blindsided and have blinkers on your head and say this company is completely overvalued. And I'm not sure it is. One of the main reasons I consider NEXTDC to be a high quality company is just the revenue growth. So this is the revenue for the company over the past 10 years, and fantastic growth rates when you look at the whole 10-year period. Revenue has been growing at 31.4% per year. Now, that's on a very low starting base because back in 2012, they had $1.24 million of revenue, but every single year the revenue grows. There's not one single year here where the revenue has gone backwards, and that's because they are building more data centers. Not sure how long it takes for a data center to get full. I don't think it's fully booked up. I think there's probably a little bit of room there, but revenue has been growing. And this is the main thing I'm looking for in every single company, reliable revenue growth. Over the past 5 years, it's been growing at 7.1%. Over the past 3 years, 8.6%. And it's going to be really interesting to see how much the revenue will grow once the two really big data centers, there's one in Melbourne, one in Sydney, come online. The Melbourne data center, I think it's M3, that's pretty big. That comes online this financial year. So we might see revenue actually accelerate from here. And that's going to be quite exciting to see the revenue grow or accelerate from here. And possibly they'll find a little bit of scale. And we're going to see cash flows accelerate from here and grow substantially. And also see profits grow substantially from here. So you wouldn't be surprising to see that $9 million of profit more than double year on year for the next 5 years. That would not surprise me at all. Now, because this company is high in debt, they do have a lot of interest expenses. So this particular slide, I have three things on here: operating income and then interest expense. Now, the operating income has been increasing up to $54.7 million in financial year 22, but interest expense is $52.5 million. That has been steady over the last 4 years. Now, it's going to be really, really interesting to see how interest expenses grow as interest rates grow as well. So that's something else you have to take into consideration when looking at NEXTDC. And that is possibly why the share price is falling right now. Possibly, there could be some analysis who consider NEXTDC to be like a REIT, real estate investment trust. And if they do consider that, and maybe you could consider this company to be a REIT proxy, then that would be understandable why the share price has been dropping, because interest rates are rising. The other thing here is gross margins, and gross margins are rising as well. And that is one thing I really look for in high quality companies, is I want to see at least gross margins staying steady. But if I see it rising and has been rising over the last 4 years, that is another benefit, another sign that a company could be high quality. Now onto the financial statements for NEXTDC. So this is the first step in my journey when I'm looking at financial statements. I look at the cash flow statement and then work my way back. I don't think I'll be looking at other statements if I remember correctly. Let's just go forward one slide. Well, we're looking at the balance sheet in the next slide. Okay, so the first thing I always look out for is receipts and customers. We already know that revenue is growing, so receipts and customers is growing. Receipts and customers, $314 million in financial year 22, and the company was operating cash flow positive, $117 million. That's not taking into account any lease payments, but lease payments is really low, and more than likely that's because they own the buildings. So they build the data centers, and I think they own the land, own the buildings, so there's not a lot of lease payments here. So the main thing is $117 million of operating cash flow, but In the investing activities section, this is very important. They also spent $564 million on the payment of property, plant, and equipment. So this company, again, is capital intensive, highly in capital intensive. They are spending a lot of money building these data centers. They also borrowed $300 million. And if you look at financial year 21, they borrowed, well, actually, they didn't borrow $800 million because it says $800 million, then they repaid $800 million of notes. But even in financial year 21, they spent $310 million on the payment of property, plant, and equipment. And right now they do have $456 million of cash on hand. So they have plenty of cash on hand, but again, they have a lot of debt as well, over $1 billion of debt. So they are net debt by over $500 million. Now onto the balance sheet. I'm not sure exactly why I included this in the slide, but the main things to look for here are the property, plant, and equipment. So non-current assets, currently that stands at $2.4 billion, but they also have $1.1 billion of borrowings in the non-current assets. Not a lot of non-current liabilities, but the main thing I'm looking for here and comparing is the property, plant, and equipment to the borrowing. So one way you could value this company is taking into account the assets, the land they have, the buildings they have, because you have to take that into account. And so you take that away from the markup and then you add back the debt. That's another way you could probably value this company. So instead of saying a markup of, say, $4 billion, you probably minus that by, say, $2.7 billion, and that is the price you are paying for this company right now. So what did I say, $2.7 billion? And then look at the total equity, $1.7 billion of total equity. So you could compare the total equity, $1.7 billion, and then compare the, say, the markup minus the property, plant, and equipment, and add back the debt, which is $2.7 billion. And if you ever see that number get lower than the total equity, you might say, well, this company is starting to look good value. So that is one way you could value this company at this point in time. But there's probably other ways as well, discounted cash flows. But when you do discounted cash flows, forecasting the cash flows in the future for this company would be a little bit tricky. But you do have some, I wouldn't say clues, but they do tell you the data centers they are building and the capacity of these data centers. So if you know the pricing structures, if you know the costs, you definitely could do a discounted cash flows, because possibly those cash flows in the future could be a little bit more predictable if you are an expert, if you know a little bit more intimately how this company operates. Another thing to take into account when looking at NEXTDC is just the shares on issue. So this is looking at the weighted average diluted shares outstanding and the long-term debt. And debt has been increasing from $59 million back in 2014 to $1.1 billion now. But shares on issue have also increased, more than doubled, from 194 million to 559 million. So that's another thing you have to take into account, that this company might do more capital raisings in the future and the shares on issue will increase, and we have no idea how much they're going to increase. They could double over the next 10 years from here, which means the shares on issue might reach or be reaching $1 billion, because the way this company funds their building their data centers is through debt and through capital raisings. Because I do consider NEXTDC to be a high quality company, valuation matters. Valuation is very important moving forward for this company. And if I see NEXTDC to be undervalued, that's when I become interested in taking a position. But you can probably throw these valuation metrics out because they don't really give a true state of the potential of this company. So P ratio right now, 462. So straight away, someone who with blinkers on might see that P ratio 462 and totally ignore this company. Price to sales ratio 14.4. Price to operating cash flow, a little bit better at 36. Now, I did a reverse DCF using the operating cash flow, and for this company to justify the current valuation, it only has to grow the operating cash flow at 21% per year, which doesn't seem too high, particularly because I do think, now this is just me surmising, that the cash flow for this company will explode once these bigger data centers come online over the next 3 years. And I think the first really big data center is the Melbourne one, Melbourne 3 or M3, and we'll have a look at that later in the video. So that's one way you could have a view of this company and judge whether it is good value right now. It's just using a reverse DCF, and at 21%, to justify the current valuation. I don't think that's too stretched, because I do think this company could grow their operating cash flow at about 21% per year over the next 10 years. In the company's presentation, financial year 22 presentation, there's a lot of information towards the back of the presentation. I think it's in the appendix. So they give a couple of case studies, and they also talk about all the data centers they are building right now. So I'll talk about a couple of those later in the video. But the two case studies they did provide are the M1 Melbourne and the S1 in Sydney. So all their data centers are called, the first letter is the city, which Melbourne, M, and the number is the data center number. So this is the first data center in Melbourne, so that's why it's called M1. Probably don't need the M1 Melbourne, so straight away M1 tells me it's Melbourne and it's the first data center. So this just tells you from financial year 13 how this company has been, or this particular data center has been performing. Technical space, 6,000 square meters, total capacity 15 megawatts. Yeah, I'm not sure exactly how to know how much revenue can generate per capacity, but this gives a little bit of an idea, because in financial year 22, a billing utilization 93%, gross data center revenue 66 million, EBITDA 54.2 million, EBITDA margin pretty high, fit out capital expenditure to date 166 million, property value very important here as well, 100 million. So just compare that total capacity in the technical space to the faculty or facility EBITDA and the revenue, and you probably understand why I'm excited when they get their Melbourne 3 or M3 and the S4 in line or in operations, because those two data centers are massively bigger than this particular data center. And I'll quickly touch upon S1, and this is fairly small too, or comparatively small, relatively small to S4. Technical space 5,800 square meters, total capacity 16 megawatts. Is that megawatts? Could be something else. Milliwatts? No, megawatts. And again, it's very similar to Melbourne when you look at the revenue and EBITDA, but this particular data center has 99% utilization, gross data revenue of 66 million, EBITDA of 51.4 million, and I think the property value at cost is 118 million. The other thing here is property value at cost, so potentially one of the ways this company could grow in the future too is as they revalue their property. That's something I haven't thought about until right now. And the other thing they mentioned in the M1 and S1 is the break even. So S1 took 7 months until they reached break even, and there was a rapid growth in utilization. And then once say about 5-year growth in utilization. So it doesn't take long for these data centers to fill up, it seems like. Now to what the company has planned in the future. I love this particular slide because it shows you the data centers they have in operations right now, the ones in build and the ones in planning. There's only one in build right now, that's M3, but M3 is pretty big. So right now they have about 10 in operation. So they have P1, P2, of course that's Perth, M1, M2 in Melbourne, C1, Canberra, S1, S2, S3 in Sydney, B1 and B2 in Brisbane. They also have an edge data center that's SC1, which is Sunshine Coast 1. In build right now, they only have that Melbourne 3 or M3, but in planning, they have D1, Darwin, A1, Adelaide, and S4, which is Sydney. And when you look at the technical specifications of S4 and M3, so M3 will be completed in the first half of 23. So land area 100 square meters, total planned power plant 100 megawatts, initial capacity 13.3 megawatts. So that's sort of the same capacity as the Melbourne one right now, but looks like the total power plant looks like it's going to be fairly big. And then look at the Sydney S4, land area 124 square meters, total power plant 300 megawatts, development commencement financial year 25. So S4 and M3 are significantly bigger than the M1 and S1. The two, what do you call them? The two, what do they call it? The two case studies provided earlier in this video. Now into the financial year 23 guidance for the company, and I really like companies providing some sort of guidance in their financial year reports. But we are now in AGM season, so we'll see a lot of AGMs in October and November. And what you will find with AGMs is companies and their managers will either update guidance or actually give first guidance for the financial year. And sometimes you will see share prices of a company rally or fall a fair bit because of these new guidance or updated guidance. In fact, today, on the 11th of October, Baby Bunting share price dropped about 20% because of the AGM. Haven't had a look why, but possibly Baby Bunting is looking much more interesting because the share price has dropped about 50% in the past 6 months or so. Now on to NEXTDC guidance, and we already know revenue is going to be higher than last year. This company consistently grows their revenue, and yes, they expect revenue to be between 340 and 355 million for financial year 23, which is an increase of 17 to 22%. They also expect EBITDA to grow to between 190 to 198 million. That's growing at between 12 and 17%. And they expect capital expenditure to be lower than last year. So in financial year 22, capital expenditure was 605 million. Now it's expected to be between 380 and 420 million. One of the reasons why it's going to be a little bit lower is because I expect M3, it is on track to achieve practical completion in the first half of 2023, with further capacity added to plan on the back of customer orders. And another really interesting thing here was electric vehicle charging units being introduced at their S2, B2, M2, M3, and S3 facilities for customers and staff. Well done, NEXTDC, for doing that. Now onto the daily chart for NEXTDC. This is the daily chart going back to August of last year. Share price reached a high of $14 back then. That was the second double top. Remember, in the weekly chart, there was a double top, and $14 was the top. So that was a technical sign that there is a bit of weakness in the share price when the share price would not get through $14. And the share price hasn't quite halved since then, but it's getting close, falling from $14 to less than $9, currently sitting around about $8.80. And about a month ago, start of September, the share price did fall through a support level at $9.70. If you go back through the rest of 2022, share price has rebounded or did rebound off $9.70 4 times in the past 9 months. So that's why that level was a really strong support level. And then once it fell through on fairly good strength, some high volume there, that meant that support level had now become resistance. We saw the share price try to test that level again about 4 trading days ago. So that would have been around about the 5th, 6th of October, but it really failed. The share price has pulled back. So share price right now is in a downtrend. Now, because I do consider NEXTDC to be a high quality company, the trend in the share price does not really matter. I want to know the value. Now, to know the value, you can't look at valuation metrics. You probably have to do some sort of cash flow or discounted cash flow. And at this point in time, to do a really good discounted cash flow, I think you do have to know this company a little bit more than I know this company right now at this point in time. So I might be able to do that discounted cash flow sometime in the future, but not right now. So if you know this company a little bit more better than I do, and you have done some sort of discounted cash flow or some valuation of this company, I'd love to hear about it. So leave it in the comment section of this video. That's all I have for this video, looking at NEXTDC's financial year 22 results. The question is, what is the intrinsic value of this company? A very important question, because as the share price falls and keeps on falling, this question becomes even more pertinent. Is there value in this company right now? And to determine that, you'll have to know the intrinsic value. I probably don't know this company well enough at this point in time to answer that question. But again, if you have answered that question, or you think you have answered that question, I'd love to know your answer. So leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.